Hi, I'm John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, May 15. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Wall Street has been overly optimistic before in betting on a Federal Reserve dovish pivot, but such hopes seem realistic now. The year-over-year rate of increase in consumer prices decelerated to below 5% in April, the lowest rate in 2 years, giving the Fed elbow room to pause interest rate tightening at its next meeting in June. We won't get a cut in rates this year, but a pause is entirely likely. That's the good news. The bad news is the Democrats and Republicans in Washington remain far apart on the debt ceiling. In previous debt ceiling fights, a resolution was found at the last minute, but this time polarization is worse. There's a radical faction in the U.S. House that are nihilistic about government, and they seem to yearn for a default. That's dangerous. Since 1917, the U.S. has enforced a statutory limit on the total amount of debt that the government can issue at any given time. The existing debt ceiling was hit on January 19. Since then, the U.S. Treasury has implemented emergency steps to pay for the country's bills. Those efforts are on track to be exhausted by June 1. We've been down this road before. The most instructive case study is the summer of 2011. Back then, as now, we had a divided Congress and a Democratic president. The crisis prompted Standard & Poor's to downgrade the U.S. government's credit rating for the first time in history. A default was avoided at the last minute, but the financial markets were put through the ringer. During the period from when the U.S. Treasury initiated extraordinary measures until the deadline on August 2, 2011, the S&P 500 plunged about 6%. The House passed the debt ceiling compromise a day before the deadline. The Senate approved it, and President Obama signed it on August 2nd. Regardless of a deal being reached, Standard & Poor's downgraded the U.S. credit rating from AAA to AA+ on August 5, and the S&P 500 plunged another 10%. Extreme volatility persisted for another 2 months, but markets eventually stabilized and recouped their losses by the end of the year. History tells us that debt ceiling battles eventually get resolved and the markets bounce back. These political dramas don't exert a long-term influence on the financial markets, but the haggling and suspense generate volatility and temporary sell-offs along the way. Odds are we'll get a resolution this time around, too. The stakes are very high, and the pressure on Washington from the financial and business communities to raise the debt ceiling is enormous. But in recent years, we've seen a lot of political norms shattered. Maybe the ceiling won't get raised, so get prepared. During the current debt ceiling imbroglio, hunker down. Increase your cash reserves. Money market funds are a good place to safely park your cash for a relatively short period. Until the crisis passes, avoid companies that rely on the federal government for revenue, e.g. healthcare providers, defense contractors, and infrastructure firms. In the meantime, the impasse in Washington over the debt ceiling has soured investor moods, with the major equity indices finishing last week mostly lower. The Dow Jones Industrial Average fell 1.1%, the S&P 500 fell 0.3%, and the tech-heavy Nasdaq, it eked out a gain of 0.4%. Crude oil prices fell 1.7% as recession fears worsened. Despite the production cuts of OPEC+, traders are calculating that the global economic slowdown will undermine energy demand. The benchmark 10-year Treasury yield closed out the week flat. The slump in oil prices is a clear indicator that a recession probably looms on the horizon. OPEC Plus announced in April that they would cumulatively slash crude oil production by another 1.16 million barrels per day until the end of 2023. The cuts started this month. However, OPEC Plus has been steadily losing clout in the global oil markets as trading in the world's most valuable commodity increasingly becomes fractured. The rise of regional oil markets has disrupted the political order. What's more, OPEC Plus members habitually cheat on their quotas. The biggest fear weighing on crude oil prices is the global economic slowdown. Now let's take a look at the week ahead. Here are the most important economic reports scheduled for release in the coming days. Retail sales and home builder confidence index Tuesday, housing starts and building permits Wednesday, existing home sales and U.S. economic leading indicators Thursday. I just explain ways by which you can protect your portfolio from the volatility that lays ahead. My colleague Jim Pierce, chief investment strategist of Mayhem Trader, has devised other investment tactics that can buffer your hard-earned wealth, but also generate gains. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now, and if you have any questions or comments, don't hesitate to send me an email at mailbag@investingdaily.com. Thanks so much for watching.